Hey YouTube, welcome back to my financial focus. In this video, I'm going to be talking about Google, who recently not only released their annual report for the fiscal year ending 2021, but they also recently announced that they will be doing a 20-for-1 stock split. So in this video, I'm going to talk about how this is going to affect investors, and then I'm also going to go into their recently released 2021 annual report to look at how their business operated in 2021, what their different operating segments were, as well as their revenue sources, some of the risks facing their business moving forward, their competitive advantage, or otherwise known as their moat in the competitive technological landscape that they're in, and then also some of the competition that they're facing. I'm also going to go into their financial statements in detail to get a better understanding of the financial health of the business. And then lastly, I'm going to do a discounted cash flow analysis using Google's current cash flows to figure out what the intrinsic value per share of the business is, to figure out what a good buying price would be for us from a value investing perspective. So I'm going to try to provide a ton of value in this video, and all I ask is that just leave a like on the video. Helps me out a lot, helps this video get recommended to the algorithm. So let's get right into it. Right here we see they announced a 20-for-1 stock split on, I believe it was February 4th, which was a few days ago. And we can see that as soon as they did that, Alphabet stock rose by more than 9% after being down a little bit from their all-time highs. We can see right here they point out that this stock split, the way it's going to work is that each person who is a shareholder of at least one share of Google as of July 1st will receive on July 15th an additional 19 shares of the business. And so for people who are watching this video who don't really understand what a stock split is, basically the share price of Alphabet Class C stock right now is trading at about $2,800 per share. But then on July 15th, this share price is going to be divided up by 20. And so anyone who is holding on to one share right now or by July 1st is going to have 20 shares, but each share is just going to be worth like 1/20th of what the current share price is. So basically they're going to have the same amount of ownership in the company, but they're still going to have more shares. And this is actually pretty beneficial, not just because for the business they're going to be able to attract a lot more investors who are smaller investors, but also because people who are holding on to one share of Google right now, if they have at least 5 shares and after the 20-for-1 stock split is over, they'll have 100 shares at that point, which means that they'll be able to write covered calls against their shares, which they might not be able to do right now because they only have 5 shares. But after the 20-for-1 stock split is done, they'll be able to collect premiums just from selling call options against their 100 shares of Google stock, which is pretty cool and is actually something that I'm going to do once the stock split is over. And then we see right here, they point out that once the split happens, each share is going to be worth about $130 to about $140 per share. So that is pretty good news for Google. This is definitely going to attract a lot more investment into their company's stock, and it'll probably increase the company's stock price because of the increased activity in their stock as a result of more smaller investors getting involved with Google. So next I'm going to go into their annual report and figure out what their competitive advantages are, as well as what some of their revenue sources are. And just to start off, we can go to page 6 where they talk about their different revenue sources and operating segments. And just to point out for anyone who doesn't really understand how operating segments work, basically whenever a company is figuring out if they're going to report a segment into their annual report or divide their financial statements by individual reports, as long as one of their operating segments makes up at least 10% of the total revenue of the business, that segment of their business gets its own separate individual reporting on their financial statements. And then every other segment of their business that doesn't make up more than 10% of their total revenues just gets put into the other income column. So right here we can see that they talk about their Google Services core products, many of which include their Google Ads, Android, Chrome hardware, Gmail, Google Drive, Google Maps, Google Photos, Google Play, Google Search, and YouTube, each with a broad and growing adoption by users around the world. And obviously, at the moment, people are consuming more digital content by watching more videos, playing more games, and listening to more music. So that puts Google at a pretty good position to profit off of the increased shift online as opposed to face to face and going outdoors and enjoying life, which a lot of people just don't really do as much today as they used to, which is obviously pretty beneficial to Google's business. And then right here, they talk about how they make money with this part of their business, and they primarily just generate revenues through advertisements, both performance and brand advertising that appear on Google Search and other properties like YouTube. And then also right here, we can see that their Google Play generates revenues from sales of apps and in-app purchases sold in the Google Play Store. Their hardware generates revenues from sales of Fitbit wearable devices, Google Nest Home products, Pixel phones, and other devices. And then their YouTube non-advertising revenue segment generates revenues from YouTube Premium as well as YouTube TV subscriptions. And then the second operating segment that they report, which makes up more than 10% of their revenues, is their Google Cloud core products, which mainly include their Google Workspace products like Gmail, Docs, Calendar, and Google Meet. And they generate revenue from these segments of their business mainly by just providing the service upfront for free. And then once people want to use the business, or not use the business, but use the products a little bit more extensively, like for example with Google Drive, if they want more storage space, then they go on and they pay for it that way. And so that's how Google Cloud ends up bringing in more revenues. And then on page 8, they start talking about their competition, and we see that they have some pretty steep competition here. Their competition with search engines is with Yahoo, Bing, LinkedIn, WebMD, and Baidu. And then also among their competition with e-commerce providers like Amazon and eBay, social networks like Meta, before known as Facebook, Snap, and Twitter, and then also with other enterprise cloud services like Alibaba, Microsoft, and Salesforce, as we can see right here. Then on page 11, if I scroll down here, they start to talk about some of the risks facing their business. And I won't go into too detail with all of their risks because they talk pretty extensively about the different risks that face their business. But the ones that caught my eye in particular were this first risk right here, which shows that they generate 80% of their total revenues from advertising, and reduced spending by advertisers, a loss of partners, or new and existing technologies that block ads could obviously negatively impact their future business revenues. And then also, if we scroll down a little bit right here, they point out that their growth rate could potentially decline over time and that they anticipate downward pressure on their operating margin in the future as a result of things like competition, as well as technological obsolescence if they fail to innovate rapidly enough. Obviously, they are competing in the technology field, and in technology, nobody really cares about what someone did yesterday. It's all about what's happening today and what's going to happen in the future. Right here, we see their stock performance, and we can see that Google is the red line, and then we can see the key right here. And we can see that Google has outperformed the overall S&P 500 over the last few years. So anybody who has been holding on to Google stock over the last few years is definitely very happy right now, because even last year in 2021, 2020, around that time, Google, their stock increased by about 100%. It almost doubled in just a little bit of a year. Right here it says 38%, but over like the last year and a half or so, their market capitalization has increased by like 100%, even though the S&P 500 has only increased by about 30%. So anyone who was invested in Google during that year definitely had a lot of fun because they beat the market pretty substantially. And then right here on page 29, we see that they start to talk about a couple of trends that are happening that their business could capitalize on. I won't go into too much detail here, but the one that really stood out to me was right here, where they point out that as users in developing economies such as India, which has a population of 1.4 billion people, they're the second largest country in the world by population, increasingly come online, then their revenues from international markets will continue to increase, and movements in foreign exchange rates will start to have a greater impact on their revenues. But I think that considering that more than 50% of the world right now doesn't even have access to internet, that Google is definitely going to capitalize from this huge untapped market, especially in a rising large economy such as India. And then next, I'm going to go into their financial statements, and we can see their first financial statement on page 50, which is their balance sheet. And so right here with their balance sheet, we see this is their 2020 balance sheet and their 2021 balance sheet. And we can see that their total assets increased quite a bit from about $319 billion worth of assets to $359 billion worth of assets in 2021. And then we can see, if we scroll down here, right here in their accrued expenses and other current liabilities, this part of their liabilities section of their balance sheet actually includes the European Commission fines that they accumulated in 2017, 2018, and 2019, when the European Commission announced decisions to take certain actions against Google for infringing European competition law. They imposed fines of about 2.4 billion euros or $2.7 billion as of June 27th, 2017, and then $5.1 billion or 4.3 billion euros in June 30th, 2018, and then 1.5 billion euros or $1.7 billion as of March 20th, 2019, respectively. And while each European Commission decision is under appeal, Google included the fines in accrued expenses and other current liabilities on their consolidated balance sheet, as they provided bank guarantees in lieu of cash payment for the fines. And so instead of just paying them upfront, since they're still appealing them, they included them on their accrued expenses using the matching principle from accounting to keep track of it on their balance sheet. And we can see that their total liabilities increased from $97 billion to $107 billion in 2021. Their retained earnings increased from $163 billion to $191 billion in 2021. Google famously doesn't really pay a dividend. They tend to just keep the cash in retained earnings and then invest it in order to grow their business faster and invest in things like R&D, AI, and machine learning. And we can see their total stockholders' equity increased from $222 billion to $251 billion in 2021. Next, we can see their income statement on page 51, and we can see that from 2020 to 2021, their revenues increased by about $70 billion or by about 41%, which is pretty incredible. That's a pretty large growth margin from 2020 to 2021. And we can see their cost of revenues came out to be about $110 billion, which was an increase of about 31% from 2020. And that primarily came from increases in TAC expenses, which for Google amount to their distribution partners like browser providers and mobile carriers, as well as software developers who make their search services available. And the overall increase in the data centers that they have, as well as other operational costs, was partially offset by a reduction in depreciation expenses due to the change in the estimated useful life of their different network equipment and things like that. And we can see that their net income increased from 2020 to 2021 from about $40 billion to $76 billion. So that's another increase of almost about 50% on their bottom line. And then lastly, on their cash flow statement, we can see that their cash flows from operating activities increased from about $65 billion to $91 billion in 2021. And then with their investing activities, we can see that a lot of their investments or investment activity came from purchases of marketable securities, which is like securities that they are basically like just investing in like other businesses or in the stock market to get a return. To get a return on their capital. And then right here we see for their financing activities, Their repurchase of common stock in 2021 came out to be about $50 billion, which was pretty substantial. Their share repurchases in 2021 in total increased by about 62%. And then we can see they repaid quite a bit of debt in 2021 as well. So the last thing that I want to do is go into this discounted cash flow model that I've created here just to figure out what the intrinsic value per share of Google is based on a couple of assumed growth rates, and as well as some of the cash that's currently sitting on their balance sheet. And so for the growth rates for years 1 through 5, I used 27.56% because that was the value that I found from Yahoo Finance just by going to the balance sheet section or the growth estimate section right here. And then for growth rates years 6 through 10, I was a little bit conservative and decided to say that for the next 5 years after the first 5 years that they would grow at about half the rate as they did in the first 5 years. For the free cash flow for year 1, I got that from TradingView. As we can see right here for 2021, it says free cash flow was $67.01 billion. For the net cash minus net debt, I got that from Yahoo Finance as well. In the balance sheet section, we see total cash was $139.65 billion and total debt was $28.51 billion. And then stock ticker is GOOG, and shares outstanding at the moment before the stock split is about 315.64 million shares. And so after we plug those values in, we can see that the intrinsic value per share based on these values right here comes out to be about $7,564 per share, with a 30% margin of safety of about $5,000 and a 50% margin of safety of about $3,700. And so in comparison to Google's current share price, that would put Google at a pretty heavy undervaluation at the moment, considering that they're trading at less than 30%, a 30% margin of safety, or a 50% margin of safety. But even if I were to decrease the growth rates to 1%, based on the amount of cash that's currently on their balance sheet, as well as their year 1 free cash flow, we can see that even if they were to grow at 1% per year for the next decade, that the intrinsic value per share is estimated to be around where their current share price is. So I think that Google is currently, as far as this model is making it out to be, seems like it's a good buy at the moment based on the current share price. But I would definitely love to know what everybody watching this video thinks. Is Google a good investment at the current share price or not? And how is this 20-for-1 stock split going to affect Google? Is this going to increase the activity with Google or increase their share price? Let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see everybody in the next one.